Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
Welcome back to Turtle Talk, Episode 5. It's Friday, the 26th of July, 2025, and I'm Rich Brennan. Joining me is my fellow Aussie turtle, who has been paddling his way around the Pacific lately, and I believe he has just surfaced in sunny Noumea. Bonjour, ça va, Adam?
Yes, bonjour. They do pretty much only speak French here, but thankfully a little bit of English in the hotels and the restaurants in Noumea. But hello to everybody. I'm enjoying my winter holiday, a little bit warmer in Noumea at the moment.
Very nice, Adam. And of course, we're once again joined by the legend himself, Jerry Parker. Where are you dialing in from today, Jerry?
A much more secure location this time than last month. New York City, West Village of New York. It's really nice here and it's pretty warm. And as much as I loved Montauk last time, I did get, the hotel did not have good Wi-Fi service. So knock on wood, I feel much more confident about this broadcast.
Well, Adam and I are going to be over in your neck of the woods shortly, so we'll check you out over there.
Wonderful.
Well, today's a very special one with two great guests, also from the Deep South. We've got Bruno from Sao Paulo and Andre from Buenos Aires. Bruno and Andre are long-time trend devotees who are no strangers to Jerry and myself, being regulars on Jerry's original Twitter Spaces on X. These guys have been flying the flag for evidence-based investing and systematic thinking in Latin America. They're not just students of trend, they're practitioners, educators, and passionate contributors to the global conversation. Today, we get to turn the mics toward them. Bruno and Andre, it's a real pleasure to have you on the show. How are things your way?
Hi, Rich. Hi, Jerry. Hi, Adam. It's a pleasure to be here. Glad to be invited for this talk. Everything's looking fine. Let's talk about trend.
Beautiful. Andre, Argentina, how is it?
Hey, how are you? Greetings from the south, the other south. I'm great today and very missing our conversations about trend following and trying to get into that again.
Lovely. Great to have you on, guys. All right, so let's get into it. First up, it's a battle of the trend following indexes. Over to you, Adam.
Yes, well, back into the black for all of the indexes, which is a relief, but I guess expected, having entered a drawdown over the last couple of quarters. We were looking to find a base in performance, and it looks like that has occurred. All of the indexes that we follow have posted positive results for June, and then informally I believe that most programs are in the black for July. I can speak to our experience here at ECCM. We're having a good July to date. Obviously things can change, but as at recording today, we're pretty much through the month. So, talking about recoveries, I think that we're now asking the question, will this be a V-shaped recovery? How many months until we get back to all-time equity highs? Yeah, sure, we could have a wobble. It might not be a straight line, but I'm moving forward on the basis that we've had the low in these programs. And so it's interesting to see the performance of the classic trend index, finding a base there with that sort of 100% return since inception of the index, massively outperforming the other indexes. And, may it continue. Richard, what are your thoughts?
Yeah, it's an interesting one, Adam. So when I'm looking at comparing the classic trend index with the other trend following indexes, the classic trend index came off its high water mark in about February this year, whereas the other indices came off their high water mark in about February last year. So I think the interesting thing I'll be looking at closely is the recovery period back to the high watermark, because my instinct tells me that with the classic trend, because of this lifting power we have, when these trends do arise, I think that we might have a very smart, quick recovery back to the high watermark. But whereas the other trend following indexes, which have a fair bit of multi-strat in them, and also they deploy techniques such as volatility adjusting, etc., I think they might have lost that lifting power. So I'd be very interested to see how quickly they can return back to their high water marks. That's my feel anyway. But it's a good start to coming out of this drawdown, and I think classic trend might have a very good result this month, which should ameliorate some of the pain of that drawdown that we've had.
Yes, and I'm just reflecting here. You've got a statistics table which is really good, and you can see here that over the analysis period, since we formed the index, which was January 2020, we've got the classic trend in the lead with the top CAGR, but also the best MAR ratio, and also Sharp and Sortino. So on the absolute and risk-adjusted returns, the classic trend index seems to have drifted to the top relative to those other indices. And it's going to be very, very interesting to see, as you say, how we come out of this drawdown.
Jerry, have you got anything to add here?
Well, I think, like I said last time, I think so a lot of the markets that we're looking at haven't moved in a long time, and they've got a lot of false breakouts, and so I think that's a good indication that things might be getting better. And then the volatility in a lot of the markets is sort of low, so it's maybe not all-time lows, or maybe it bounced off the low recently, but over the past few years, I think the typical market, the typical ATR, is low. That's a good sign, not only for being able to load up at the breakout, since that's how we size the positions inverse to the ATR, but also it's kind of a technical sign that people are sort of uninterested and bored and tired of losing money in these markets. And that's when our strategy and our rules and our consistency and our discipline kicks in. And it could be a good pretense for markets looking a lot better than they have been.
Bruno, what are your thoughts? Any thoughts on the report for last month?
Not specifically from last month, but I'd say that over the last couple of months, the thing is that all those open trades that have been closing have been reaching their end, and that's what brings the strategy to some drawdown. Hopefully, some new trends appear. So hopefully, some old trends kick back in.
Poor old Andres dropped out. So, look, we might move on and into our segment, What's Moved the Needle? What's Moved the Needle is about where we break down the price action and momentum shifts across the futures universe. So June was less about breakouts and more about rotation. As grains and equities faltered, strength flowed into the crypto, metals and softs. Of course, we did have some good short positions in some of the grains, such as the soybeans, which I think Jerry's going to bring up. But Adam, over to you first. What charts stood out to you?
Okay, so I flicked over the S&P 500 and the NASDAQ, and I gave you a 5-year chart this time just to get a little bit of perspective on the market. Now, we're making all-time highs, which, is even more bullish than, a 1-year high or a 2-year high. So I don't think there's anything more bullish than an all-time high in a market. And obviously, we're well above the long-term moving averages. And everybody should be long if you're adhering to the trend-following style and philosophy. So, filter out the noise, any pessimism, whether it's warranted or not. These equity and risk markets are moving up. You should be long. You should be enjoying the profits that are being distributed to your accounts if you've been following the signals and taking those breakouts at the relevant levels. So, you may have been shaken out of the trend. S&P 500, it had a huge correction, and it looked a little bit wobbly there. But now that we've recovered, you've got to have the courage and fortitude to get back onto those trends. And that's also reflected in Bitcoin prices, which I view it as the ultimate risk asset. I know some people view it as something more defensive, but that is also breaking out. So whatever your personal views on this, there's a futures contract, it's liquid. We've got the information, all the information that we need to trade it. And, you should be long this market from a trend following perspective. No ifs, no buts in that regard. And Jerry mentioned some metal markets. Yeah, I don't want to go into too much detail because we talked platinum last week, and it's had a huge move up, 50%. But the big news in the last couple of months, the last month or so, copper with the tariffs, that was a huge one-day move. And, we're enjoying the rally there. And then one little micro market that I want to, look at, it's something a little bit more exotic, and that's the feeder cattle prices, which have gone to record highs. And I confess to knowing absolutely nothing about the cattle market except for the multiplier on the contract and the ATR. And basically that's all we're really needing to trade this market, which is just delivering fantastic returns. And I'm just loving the trend line on that market as it goes from the bottom left of the chart to the top right of the chart. And look, that's about it from me. Jerry, what are you looking at?
Well, I don't know if we're ready for the first bit of controversy. We're only 10 minutes in, and I think I've come up with my next month's Mythbuster, Rich, and that is, quoting Adam here, nothing is more bullish than all-time highs. I definitely don't agree with that. So next month, I'll get into that next month. I think the grain markets are interesting. We've been short wheat for a long time. 4 or 5 different wheat contracts, that we trade. I think it's 5 because we trade South Africa and France, and the 4 in the U.S. So they've been in really nice downtrends, and they've rallied a lot, had some vicious rallies, keep going down. Corn and soybeans as well. But the charts I looked at were the beans and the meal and the oil. And, you got the soybeans and the meal, kind of a meal, especially in a really nice downtrend, beans somewhat, but then oil's in a big uptrend. So, and I just wanted to make the point again that trading all of these markets is kind of the best thing to do if you can. You cannot choose 1 or 2 from the grain sector and have them represent what is happening in all the different grain markets. Well, you can, and people do, but it's not going to be as good as trading them all because they have different names, so they're going to have different performance and different activity. And then you throw trend following on top of it, it's going to look even more different and less correlated. So I'm happy. And then, of course, in 2020, oil was a huge, when all the grains went up and all the commodities rallied after COVID, or after the start of COVID. Oil was really one of those that had an outlier move as compared to nice moves in some of the others. So hot off my debate with Bowmore, I still can't give it up that I'm going to trade many, many markets. And I don't like the idea of choosing 1 or 2 from a sector and saying, oh, I've got that sector covered. You know what? You don't.
Well, I think that's one thing that we can agree on. I think having the diversity in the contracts is important, and we've been seeing with this thing going on in the Middle East and some of the traffic disruption with the tankers, you've seen some distillates move differently from the underlying contracts, and so weird things can happen even in these related markets. And I think, Jerry, you were looking at those bean markets that are exhibiting different trends in different parts of that related commodities complex.
You brought up platinum, and that's another really good example of how gold takes off. Silver is a little behind it. Platinum is doing nothing for so long. And so I would prefer to kind of wait and see if I'm going to get a platinum move, wait and see if I get some diversification. So I've never been a big fan of, well, I'll just trade gold because it's the strongest and don't worry with silver and platinum. But there's nothing to say that these markets in that sector that are sort of late to the game, late to trending, they can't catch up and even go faster and further and be as good or better trades than the market like gold that took off first. So I'm a big fan of not doing a relative strength type trading, or not just waiting and taking advantage of the possible diversification like that platinum has now given us.
The interesting thing about these sector representatives is that at some time they may correlate positively for whatever reason, and then that correlation can turn in its own head. And then, if you think you have that sector represented by one contract, then you find out you don't. The soybean is a good example. You can think of that as a mix of meal and oil. When you crush the soybean, you have meal and oil. And for some time, the main use of soybeans was the meal. So the oil was kind of a byproduct that, well, okay, you can use it to cook, that's fine. But for the past 10 to 5 years, you're increasingly using soybean oil as an input for biofuel. So the main byproduct of the soybean became the oil, and then that correlation inverted. So that's just to make an example for why you should have as many contracts as you can, or as many markets as you can in your own system, just to grab these new features that appear over time.
Well, I really love having a smart person on the podcast who knows some of these fundamentals. So all of us sound so much smarter now. That's awesome. I wish I had known that beforehand, but that's good to know.
Your job, Jerry, is to make money with the trend following. My job as an economist is to explain why things happen.
Yes, thank you. Your mother is more proud of you than mine is of me. So, but
the comment I'd like to make is that I can understand why some people believe that the Bowmore line, the mutually exclusive line that they mention. I don't think that is relevant for outlier hunting, but I do think it is evident in different forms of trend following, those that are dealing with cross-asset class correlations, etc. Because being an outlier hunter as we are, it's the idiosyncratic movements which tend to separate those markets that are contained within an asset class. So with energies, for instance, spot crude or WTI crude and Brent, they can have considerably different correlations in the outlier regions. But when we're looking at cross-asset class correlation trend following, which a lot of the managers seem to do, they do tend to sort of have fairly generally the same profiles at all periods of time. So it's these outliers which are sort of unpredictable, They occur as anomalies. We don't know when they're going to occur. When they do occur, they don't come across all of the markets in the grouping. And cocoa is a prime example. We can get an outlier in soybeans, and we don't get the same outlier in soy meal or soy oil.
Well, Rich, remember when WTI crude went negative, but Brent did not. Now, that was a location-specific issue, related to delivery in that region. And so, you've got to get into the fine print of those contracts. That's not our job. We're following the trend and the price action. But there's obviously these, market or contract-specific issues that can drive, as you say, those outliers, left and right tail.
Yeah, so I think the argument comes down to whether you're an outlier hunter or not. You might still classify yourself as a trend follower, but I do think that there are distinct differences within the trend following grouping, those that are focusing on outliers versus those that are focusing on other forms of trend.
Yes, that's true. And also I think that to some degree, if you're doing a heavy dose of correlation and volatility management and reducing position sizes and making the outlier trades more normal and making it look like the rest of the markets in the sector, then this has a tendency to make it not as important to trade all the different markets. Like the outlier hunter is looking for the idiosyncratic, and these people are taking an idiosyncratic and saying, I don't like idiosyncratic. I want to try to strip that out of this market and make it look more like everything else there. We want more of a normal distribution. So I think that I haven't done that research at a high level, but I think that might have something to do with it too, that it doesn't really bother some of these managers like the ones we've mentioned to trade fewer markets because it wouldn't really help like it does with us.
Yeah, and then I think the big no-no is reducing the exposure to the outlier as it starts developing. I just think that's just the worst. That's the worst idea, in my humble opinion, is looking at a trade that's performing and adding value, and then deciding to take risk off as it develops.
Yeah, sometimes, especially a period where the stocks were crashing. I hate to bring up 2008, but the stocks were crashing. Traditional portfolios are getting destroyed. CTAs are the only thing really making money. They're short all of these indices. Halfway down to the lows, they're buying them back. And you're taking away, you're only allocating 5 or 10% to CTAs to begin with, and then you're taking away, they're reducing the amount that some of the exposure in those short indices that the people who invested in them actually need at that point in time. Why? Because they want a smoother return. They want a higher Sharpe.
This is going to have impacts on resumptions back out of drawdown. This is why I feel that, I was talking earlier about the rate of recovery back to the high watermarks. I think we're going to find that there's going to be a symptomatic problem with a lot of the other forms of trend following, where they take a lot longer to recover to their high watermarks because they are not sort of exploiting the outlier potential of these trends that we're currently seeing in play right now.
Good point, Rich.
But Bruno, any other points you'd like to mention before we move on to our next segment?
I'll just add from the ideas you've already discussed. I think that when these short-term trends or getting out of a trade earlier, you're basically, as Jerry pointed out, you're basically making it the distribution of your trades more normal and less asymmetric as they could be, as they should be. And it's all about the asymmetry of the trades that trend following shines, right? So it becomes it's a different risk portfolio. It's a different return profile. I mean, and it depends on what you're going to get or what you want to get.
All right, well, let's move on to our next segment, which is Rising Stars and Trend Titans. So this is where our monthly report, which is produced by ATS, where we highlight the standouts of the systematic space. So I'll start with you, Adam. What's caught your eye this month?
I'll have to go and talk about the elephant in the room, Rich. Field House Capital, up 4% last month and up 20% in the last 12 months. And I'm like, well, how did these guys get into a trend following index? Because every other trend follower that we look at is down over that period. And so I did do a little bit of digging, and it looks like they have a mixed mandate, which on one of the reporting platforms says 50% systematic, 50% discretionary. And Jerry, I don't know if you got any thoughts on that, but what the hell is 50% discretionary and 50% systematic? Isn't that just 100% discretionary?
Yeah, I'm not an expert on discretionary, and not only I don't like discretionary, but it would just be almost impossible probably for me to like their systematic. So I'm not going to complain about the discretionary too much, because most of the time, unless it's the few little friends on this podcast or a few other guys, and girls, but I'm really not agreeing with how other people even approach systematic trading. So good for them. I have not heard of them. I will do some research as well. So
we've got to find out about them. 46% CAGR over 5 years. This makes Mulvaney look like a minnow.
Look. Let's move on, right? Because they're a small manager, but as Jerry says, good for them. Let's move on to the dispersion table. We're still reporting low dispersion between managers. Now, we were talking before the program about dispersion. Rich, what are your thoughts? Do you have anything to add to last month's comments on dispersion?
Yeah, look, one of the things that comes to my mind is that during difficult times, I do think we get a splay in dispersion. We get some who are classified in the grouping who do well, and others do poorly during the difficult times, and we get this sort of divergence of the dispersion. But when things start trending, I tend to think we get a more concentrated grouping in general. However, that needs to be supplied with a caveat with what we've been talking about when we get into outliers, because that's where we can get dispersion again occurring when some of the trend followers who deploy techniques that specialize in the tail regions significantly accelerate away from the rest of the pack. So it's interesting to see that the dispersion has dropped for last month, which I assume is due to the more positive times, more trends about. But during difficult times, it splays. But then when outliers come into effect, it splays again. So that'd be sort of my comments, Adam.
I know that in equities there's that expression up the stairs and down the elevator, and I just wonder, does that apply to trend followers, or is there like a different expression that we have to all come up with? Bruno, do you have any thoughts on this? Because you probably looked at it in a macro sense.
I'm laughing because we have a dirty version of that here in Brazil. You eat as a bird, and you as an elephant.
I see.
It's the return profile, right? With trend following, you're hoping to have a positive asymmetry, in that you expect to lose most of the trades, which are going to lose less, and you expect to win a few of the trades, but those few that you win make all the money you're expecting.
Yes, but Bruno, the point we're making here is if we compare the different managers, right? So we're all trying to do this, and we're all in some ways doing it in a unique way, because Jerry's program is not my program, and our program is not the same as Takahei's program, right? So we're all delivering different results, and what we're asking is the industry as a whole, or when you're comparing managers, can the dispersion in returns between the managers, the difference in returns between the managers, is there some insight that investors can get, timing allocations, choosing managers? Is there something in there that's valuable for investors in assessing this asset class?
I guess there's a common component of trend that is underlying all the systems or all the programs. But fundamentally, there is a difference in each of them, depending on, as you said, that depends on the system itself. But when everything is going similar, I don't know, perhaps that underlying component is predominant in that time, and it's most of the time is when not many trends are appearing or are showing up.
Yes, because I guess if you did correlations between, let's say, outlier hunters, if we could like separate outlier hunters from vol controllers, right? There is an overlap in returns, and there are periods of time when both make money. And then the question is there a statistical difference in the risk-reward ratio that those two groups can exhibit? And then, are there times when one outperforms the other? Now, looking at our classic trend index, you can see there that the absolute returns have been superior for our group of outlier hunters. I guess it's a small sample size because it's only three firms in that index.
I think if it depends on the window of analysis. Take for example the S&P index for the past 6 months. It up until March it had made a new high. Then in April it went down viciously. Now to make new highs again at about June or July, not sure, in the last weeks or days. So if you're a short-term manager, a vol controller or something like that, you would see that high reflect in your P&L. Then when it goes down, at some point you're going to stop, and that loss you're not going to make it back for some time because you're out of that market. Whereas the long-term trend follower would perhaps still be long all that way and run down that drawdown of the S&P and back to the new high again. So when you look at the monthly performance of that trade, suppose you have a system that trades only that. When you look at the performance of that trade, you would see that up until April, the vol controller or the long-term trend follower would have similar performances. In April and May, probably the vol controller would have a negative performance, but not that much. Whereas the long-term trend follower would probably have a much more negative performance. Then to get back on June and July, the long-term trend follower would have a much more positive performance. Whereas the vol controller will be out of the game, either because the vol is too high and he had to reduce positions, or because he had to effectively stop because the drawdown of the S&P was too much for its system to handle.
Yeah, that's a good point, and I think that gets back to how loose are your pants, and not every market scenario is optimal. For every system. I guess that's why all of us run multiple systems and then try to have exposure to as many markets as we can digest. Jerry, what are your thoughts? Should we be looking at this like on a short-term basis? Like, is it even worth doing monthly, quarterly league tables for us versus other people, or ranking, or is it really about the long term How long do you need to have a track record to assess a trend following manager?
Well, I agree with our professor who kind of came up with the idea years ago that the most reliable track records to look at are the ones that have many, many years, decades of trading. That's the best indication of talent and the type of systems that people are trading. And I agree with that totally. I mean, it's easy for me to say because I have a long track record, but I don't really, I like looking at what's going on recently and over the past months or years, but I don't pay a lot of attention to it because I know it really matters. And with so many people in my lifetime, I have been told so many times that this new trader is just the greatest and is going to really kick your butt. And it's really, you need to sort of learn from them. And then after a year or two, you don't hear from them any longer. It's still fun though, to sort of try to understand what people are doing and try to, even though I'm very critical of some strategies and I don't agree with 21 markets, I have to acknowledge that Bowmore's returns are pretty impressive. And I have said when I first heard about Bowmore and I looked at the track record, I immediately came up with this idea that they're saying, look at these 21 markets. But they're trying to fool us because it's not about the 21 markets. They have really good systems, and they're doing something unique on the system side. They must be, and I applaud that, and I welcome learning more about that. But so I have to acknowledge their amazing track record, and I do, and I hope I can have that sort of run like they're having.
Well, who knows? Maybe we can get the Bowmore guys on here and ask them directly. Maybe get a little bit of a counterpoint.
Yes.
On this subject. Who knows? Who knows what's coming?
Do they bring boxing gloves?
No, they're very gentle, very nice guys. But they have a lot of funny things that they say. And one of the things I thought was pretty humorous, but I didn't get into it with them at the last podcast, but I would like to talk to them about it, is that they were very impressed with Ed Sekota's singing abilities, and that he had created this song. I think it's the Whipsaw song, and they said that in their culture there's a lot of singing as well. So maybe they'll have a song for us about MISI, mutually exclusive, comprehensively exhaustive. So we'll ask them to bring their guitars. Oh, they're amazingly catchy. I mean, they've got an amazing amount of little cliches and sayings, which is a talent within itself.
All right, gents. Well, let's move on to Spotlight. Now, unfortunately, we've lost Andre. The wireless in Argentina has just gone down, or something like that.
He's cutting everything. He's cutting the internet now.
He's cut communications. Fuego! Anyway, but we've still got Bruno here. So this Spotlight, Bruno, is going to be on you. So let's take it from the top. I'll ask my questions first, and then Jerry and Adam can batter you with some questions as well. So here's the first question. What was your first aha moment with trend following? And was there a specific experience or insight that made you go all in?
I'd say it wasn't actually a one aha moment. It was more of a process. When I started working at the market, I came as an economist. That's what I am still today. Then I started studying more of the finance aspect of economics, and then I started working or studying, better saying, the factor literature. It's a classic model of finance that you have underlying factors beneath the market prices, and that they explain what happens in the markets. And many asset managers, quantitative asset managers, try to exploit the markets in that way, and with this factor approach. And when I started studying how factors performed in Brazil, where I live and work, I found out that the most prominent factor, or the strongest factor, was momentum. And from there, I jumped to trend following and started studying trend following, started listening to podcasts where you guys spoke, started talking with you guys and developing my own system, and that's where I got it. So that's why I say it was more of a process and convincing myself of what I could actually make work versus what was basically or just academic study. And I found my I don't know, I could make something worthwhile in trend following and not on the rest.
So, what differentiates trend following, in your view, from other investment styles?
I think that the main difference is the return profile, as I said earlier. There are a few strategies that can exploit a divergent return profile, in which you earn money when things deviate from the norm or deviate from what you expect. Most strategies are focusing on a convergent return profile, in that things are out of the norm and they should come back. And as they are out, you calculate or wonder if that thing is anomalous and it should return. So you build your strategy on that idea. A great example of that idea of that strategy is a carry strategy, in which things stay out of equilibrium, but not for too much time. You bet that they will get back to a long-term mean or something like that. Whereas a trend following, you expect that things are going to change, and you prepare for change, and you capitalize on change. And when things are back on normal, you're out of the game already.
So, look, do you focus exclusively on trend, or do you also integrate other approaches in your portfolios? What's your view there? Should you be 100%, or should you play with other styles as well? Now, remember, Jerry's here.
I do think that trend following should be a significant share of everyone's portfolio, especially because that trend following is so different from everything else. So following that old rule of thumb that you shouldn't put all your eggs in one basket, the trend following should be a pretty good basket, because it's so different from every others. But what I actually do is that, well, as I said, I'm an economist. I work for an asset manager more as a strategist, more as a global macro strategist than a trend following manager or anything like that. So what I do is I'm always analyzing the market, and I'm always trying to get some idea of what's going to happen. That forbidden word in this podcast, that is predict. That's what I'm doing all the time. But the thing is,
as an economist, you can't help that. Surely,
yeah,
surely that comes with the condition.
It's my job. But even if I'm not employing trend following models in itself, I'm always getting a look on what my model is saying, because it gives me a lot of good ideas. When a breakout comes around, I see and I think, oh, what's going on here? What's happening here? Should I dive in this market? Should I see what's going on here? Is there anything for me to learn from this market? And in a way, my trend following portfolio is that it helps. My trend following model, it helps me evaluate the market, evaluate what's going on, grab new ideas. It's in a way, it's an indirect return generator, because it doesn't generate returns in itself, but it generates idea that I communicate to the rest of the team, and they have their own strategies and their own way to approach the markets.
All right. Look, I might pass it over to Adam and then Jerry, and then finally give you a chance to ask Jerry and Adam some questions as well. But let's go to Adam. Adam, any questions for Bruno?
Well, I guess the question, if you're using the economics to make predictions, which is a valid approach.
That's okay, guys. You can roast me here. It's fine. I came prepared.
Well, we're getting to that. We're getting to that. You haven't seen the second part of the question. So you've used these analytical tools, and that's fantastic. And then you've come up with a prediction. Has there been an example that you can think of where the models, the economic models, have made a prediction, but it's worked out not to be such a good outcome? Monetarily or just prediction based, but trend following and momentum actually would have saved you bacon if you had just followed the trend instead of the prediction with the economic model.
Oh, many times. The thing is, the economic models, they are built on that convergent idea. They are built on the basis that what happened in the past should happen again in the future. What happened in the past is my basis for analysis and what I can think about what's coming next. And every time a model fails, is that things different happen. So my prediction failed, and things were not what I was expecting. And that's the main thing. So that's why I think, for me especially, trend following is so valuable or so interesting, because it makes me think what's wrong about my models, what's wrong about my predictions, what am I missing here? That's what I think.
Jerry, do you have a question?
Well, I'm sort of sitting here stunned that Bruno doesn't want to put all of his money into trend following. But just to comment on that part, I would say that I know it's a little bit different, but trend following is a great strategy, and its momentum is probably the best strategy out there from a return risk point of view. And we have more diversification than any other strategy. Usually we can access more markets with our strategy because it is sort of rules-based and not based upon fundamentals and knowing too much about what's going on underneath in these markets. So I don't think we're missing too much as it relates to diversification and safety. And then, of course, I just refuse to have any investment that doesn't have a stop loss and a trailing exit. I do have real estate, and I wish I didn't have it sometimes because I needed that stop loss or that trailing exit. So I'm going to stick with my trend following plus nothing.
Well, what do economists do if you make a prediction that something's cheap and then the price goes down? Did that mean that it's now double cheap? And do you add more? Do you borrow some money and buy some more? I don't know. What do you do? If your model doesn't switch and then tell you, for some reason now it's not cheap. You could get yourself into a real pickle, right?
Yeah, it's totally. I work mostly in the discretionary realm. So the stops, they're there. They're there because we have clients to answer to. So you look at the performance and you say, okay, you can think whatever you want, but that's enough. You can't lose more. There is a stop. It's not just rules-based. It's not precise, but there is a stop. Everyone has a stop.
All right, gents, look, I know Jerry's, we're running out of time for Jerry, so I want to move on. So let's get on to the Mythbuster segment. Jerry, your myth you'd like to bust this month, is the S&P a good trend following system? And you say no. Please lead on, Jerry.
Yeah, I don't think this is something that I hear a lot, and unfortunately I hear a lot of it from CTAs for some reason. I think they want to let everyone know that they're pretty happy being just a small part of a portfolio that's really there to serve the master S&P 500. But not me. So I just have a few bullet points and a couple of longer things I want to say. I don't think it's a good trend following proxy. It has nothing to do with trend following too much. I don't think there's no entry or exit rules like we have in trend following. Oh, of course, they trim back when a stock becomes worth less, and they bump it up. They bump up the weights when the stock goes up. And trend following is more like equal weights, and we don't allow our performance to be dominated by 7 markets or like the S&P would. They don't go short. They really don't even exit. It's really good not to exit really and just sort of trim back when it's a V bottom and everything rallies, and that's great. And then you're in a situation where that's horrible for trend following, for real CTA, diversified CTA trend following. That's bad for us. So if it has any CTA qualities or trend following qualities, it certainly doesn't correlate or sync up with ours, because we're bad when they're good and they're good when we're bad. So I'm not a fan of looking at this index as if it has any sort of good trend following characteristics. Trend following can actually improve the index and get away from this 8 to 10% return and a 50+% drawdown. There's nothing that the index can do to really help trend following. If you combine the two historically, the back test would say, give me diversified trend following with at least 50 to 80% of the portfolio, and just a token amount for the S&P index, even after this. And at some points in time, like the end of 2008, of course, it would probably want 90% of diversified trend following. I bought Tesla in October of 19, around $20. The ATR was 71 cents. When it got input into the S&P 2 years later, it was at $216.
Did you buy that on a model signal?
I bought it on a breakout. That was 276 ATRs later, after a simple breakout that the S&P said now it's in the index. And what kind of trend follower is that? You kind of missed that trend, and it happens all the times.
That's like statistically, I was going to say impossible, but like improbable. I don't know like how many standard deviations that is, but
it happens all the time.
Yeah. Oh yeah. So they have these random haphazard entries where it gets put in there, and there's a committee. I don't think there's a really hard and fast rule. Obviously, it has to be a large company, but there's no hard and fast rule of what gets put into the portfolio. And there is this. You've seen these papers. Does trend following work on stocks? That was a paper that my friends did years and years ago. People have come out with this more papers, and what they'll say about stocks basically is 4% of the stocks historically have made all of the money in the index. Nothing else has really been much of a contributor. 96% of the stocks don't really contribute any better than a T-bill to the performance of the index, where it's the exact opposite in trend following. 96% of the markets do make money in trend following, whether it's currencies, commodities, interest rates, or even stocks. I don't know if that number is 96% or 99%, but it's a really high number. And from our point of view, as you know, all of these trades, well, maybe from my point of view, all of these trades, trend following trades, have the same expectation per trade. But of course, historically, that has not really been the case. But going forward into infinity, this would sort of be the case, that they're all approaching to come to the basically, if we had enough data, the same expectation per trade. So we could expect at some point in time that all the markets would contribute in the same way. Now, the S&P does hold its winners, and it holds winners. It keeps increasing the weight of the winners. It keeps reducing the weight of the losers. So maybe there's something there, I guess, if you wanted to twist it and make it happen. One of the good things about the S&P, I'm kind of get into a controversial topic here, is that it doesn't reduce its positions based upon vol and correlation. So to some degree, it's even a better trend follower than some of our managed futures CPA friends. I like that.
do you think that this argument made by people like Green about passive allocations, do you think that there is the potential for an S&P index crisis, or just a passive crisis where as you say, it just keeps allocating more money to the bigger stocks,
and those bigger stocks keep going up, and then
they reduce their cost of capital, which allows them to do better deals and grow their market share. And then is there a tipping point? Is there a point at which this all unwinds? It might not even be
go
graceful.
up forever.
I think it's going to. I think it's probable that it will unwind, but possibly for reasons that people haven't been talking about. I think that it's sort of lucky. The S&P is very lucky. And, I think there's this pipeline into the S&P, especially from Americans. I'm not sure about your countries, but that it's just, it's just more money flows in and these stocks get bought and they keep going up. But they keep having great earnings as well. So I guess it's somewhat fundamentally justified.
Yeah, I'm not so sure it's about the rules behind the S&P that make it earn so much. Other stock indices around the world have similar rules to the S&P, and they're not nearly as good performers. We had recently the example of the index in Japan that closed its drawdown from 1990s. It took about 30 years to close its drawdown. It's completely different from the S&P. The S&P had its own bad patches as well.
That's a good point. I mean, I don't think any CTA could have as bad a return risk profile. From a diversified point of view, there's nobody who can make 8 to 10% with a 50+% drawdown. It's almost unheard of. And a lot of that is going to be due to stocks only versus currencies, commodities, stocks, bonds, long and short. But I do sort of agree with you there, Bruno. But I think that what the rules, what makes it so powerful versus other alternatives is the rules. And the alternatives in the U.S., anyways, are these people who are trying to beat the S&P is discretion. So even as poor as the rules are, they're not very trend followy at all. None of us would accept it as a trend following system. It's ridiculous. So, but it is basically rules still. As bad as they are, there's still rules, and it's competing against people who charge higher fees than zero, basically, and are not as committed as to rules as the S&P is. So I do give it credit that as far as it goes in beating people who are trying to beat it, it does a very good job. And I think that's the secret of this index. It's a system, and that's why it's hard to beat, and that's why it's hard to beat us, because especially if your system is classic with fewer parameters and fewer rules and fewer optimization.
Yeah, I agree with you there. And around the world, you have people trying to beat their own indices and failing.
Even if it's an index, like you mentioned, that's not nearly as historical good performer as the S&P.
All right, gentlemen. Well, it's an hour's up, and Jerry needs to leave, but so we might have to wrap up this episode. Once again, we're going to have to delay the shell mail question from Slav for next month. So actually, it won't be next month. It'll be a couple of months from here. But huge thanks to you, Bruno. Sorry about Andres cutting out. We hope to have him back for another episode, so he won't miss out. But many thanks, Bruno, for your time. It was great to see you again. We miss you.
Thanks for having me. It's been a pleasure.
Yeah, it's fun to see you. You're great.
And look, before we sign off, a quick heads up. The Aussie Turtles Trend Following Guide is about to drop. This is Adam and my flagship book on all things trend following, packed with philosophy, process, and practical wisdom from the turtle trenches. So keep an eye out for the release. It's coming very soon. We'll catch up with you all again in September for more charts, conversation, and trend talk. And Adam and I are hitting the road at the end of August to catch up with our trend-following mates in Vietnam, Europe, and of course, Jerry, you in the US. So we may need to take a rain check for next month. So until September, stay systematic, stay patient, and as always, may the trend be with you.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time. And as always, may the trend be with you.